What if I told you that the path to financial freedom is simpler than most people think? Not complicated, not reserved for the wealthy. This isn't rocket science, and that's exactly what I want to show you today. It can literally start with just £500 a month. But here's what genuinely bothers me. Research shows that only about 1 in 4 people in the UK currently have a stocks and shares ISA. That fear, that hesitation, is costing ordinary, hard-working people something they can never get back. Time. Because £500 a month, invested consistently into just 2 ETFs inside a tax-free ISA, has the potential to completely transform your financial future. We're talking about turning £500 of your regular contributions into a pot that could be worth well over £250,000, tax-free, on autopilot. No stock picking, no market timing, no stress. In this video, I'm going to walk you through 2 ETFs that are widely used by UK investors, how they work, why this specific combination makes sense, and what your money could look like in 10, 20, and 30 years. But before we dive in, one important note. Everything in this video is purely for educational purposes. It does not constitute financial advice. Please always do your own research, and if in doubt, speak to a qualified financial advisor. Your capital is at risk. Let's start with an uncomfortable truth. The UK is a nation of savers, but not a nation of investors. And that distinction is costing millions of people a fortune. Research from 2026 shows that 1 in 6 adults in the UK, that's nearly 9 million people, have no savings whatsoever, and 2 in 5 have £1,000 or less. They are just one unexpected bill away from serious financial difficulty. But here's the part that really gets me. Of the people who do save, the majority are keeping their money in cash, places that feel safe. But here's the reality most people are not being told. Inflation in the UK has been running well above the average easy access savings rate for most of the last 5 years. Which means, in real terms, cash savings are actually shrinking in value every single year. Quietly, slowly, year after year. What if the entire strategy fit on a single page? 2 ETFs, 1 account, 1 monthly habit. That's it. That's what this video is about. Before we talk about what to invest in, let's talk about where you put it, because this single decision could save you thousands of pounds over your investing lifetime. The account you want is called a Stocks and Shares ISA. ISA stands for Individual Savings Account, and the key word, the word that should make your eyes light up, is tax-free. Every penny of growth inside your ISA, every capital gain, every dividend, is completely sheltered from UK tax. You can invest up to £20,000 every single tax year. Imagine 2 people. Both invest £500 a month for 20 years into the exact same 2 ETFs. The only difference, one does it inside an ISA and one does it outside. The person outside the ISA could pay £20,000 to £30,000 or more in tax. Same investments, same habit, thousands of pounds difference just from choosing the right wrapper. So rule number 1, always use your ISA allowance first. I want to talk about something that is arguably more important than which ETFs you choose. It's called pound cost averaging. And once you truly understand it, it will completely change the way you think about investing forever. Here's the concept in 1 sentence. You invest a fixed amount, in our case £500, on the same date every single month, regardless of what the market is doing. Rain or shine, bull market or bear market, £500 every month, like clockwork. When markets are rising, your £500 buys fewer units than it did last month because prices are higher. But that's completely fine. You're still building. You're still compounding. The habit is working. When markets fall, the instinct is to panic, to stop investing, to wait for things to settle down. But think about what a falling market actually means for someone investing £500 every month. Your £500 now buys more units than it did last month. You are getting the same assets at a discount. It's like your favorite shop having a sale, and instead of going in and buying, most people walk away. The FTSE 100 dropped 31% during the 2008 financial crisis. The COVID crash of March 2020, the market dropped over 30% in weeks. Those who kept investing their £500 every month came out the other side in a dramatically stronger position. The average bear market lasts around 289 days. The average bull market lasts 3.8 years. The market spends far more time going up than going down. The biggest mistake is not picking the wrong ETF. The biggest mistake is stopping. Think of it like a snowball rolling down a hill. Every month you invest, you're adding more snow. The hill is time. Don't pick it up. Before I show you the two ETFs, I want to address something. If you've done any reading about investing, you'll have come across the traditional portfolio. Equities and bonds, stocks for growth, bonds for safety. But here's what happened over the last 5 years. UK government bonds fell nearly 24% in a single year. 2022, the worst bond crash in modern history. The cushion failed completely, even including the interest income. Anyone holding a standard UK gilt ETF over the last 5 years has actually lost money in real terms. Roughly minus 3.5% over 5 years, total return included. So this portfolio takes a different approach. Instead of equities and bonds for VWRP, we use equities and gold. Over the same 5-year period that bonds lost money, gold returned over 130% plus. Let that sink in. So, in 2022, KSAR's 70-30 portfolio blended return was approximately minus 1.7% in GBP, almost completely flat, while bonds fell 24%, while pure equities fell 7.76%. That is genuine diversification working in real time. Before we move on, please subscribe to the channel and hit the bell icon to keep getting these informative videos. ETF number 1, the engine of this portfolio, the Vanguard FTSE All-World UCITS ETF, ticker VWRP, listed on the London Stock Exchange, priced in pounds. When you buy VWRP, even if you start with just £350, you instantly become a part owner of over 3,700 companies across 49 countries. Apple, Microsoft, Samsung, Nestle, Toyota, HSBC. You are not betting on one company. You are not betting on one country. You are buying a slice of the entire global economy, and you do not have to manage any of it. The index does that automatically. The annual fee on VWRP is 0.22%. That is 22 pence per year for every £100 you have invested. Compare that to the average actively managed fund, which charges 1 to 2% per year and fails to beat its index most of the time. VWRP is what's called an accumulating ETF. Any dividends paid by companies inside the fund are automatically reinvested back in on your behalf. You don't receive cash. The dividends silently buy more units for you. Let's look at what VWRP, your global equity engine, actually returned for UK investors year by year. And I want to put each year in context, because the numbers alone don't tell the full story. 2021, up 19.42%. The world was reopening after COVID. Markets surged. A brilliant start. 2022, down 7.76%. The Bank of England and central banks around the world raised interest rates at the fastest pace in 40 years. Markets fell. But here is something important. In GBP terms, the fall was less severe than many investors realise. Sterling also weakened that year, which cushioned the blow for UK investors. Down 7.76%. Painful but absolutely survivable. And if you kept investing your $500 every month through that dip, you were buying thousands of units at a discount. 2023, up 15.15%. The recovery begins. Those who stayed in were rewarded. 2024, up 19.28%. Another strong year. Global markets continuing their upward march. 2025, up 14.12%. A fifth consecutive positive year. Apart from 2022, consistent, reliable global growth. And 2026, we are only partway through the year, and VWRP is already up 5.51% to April. 5 years, 1 negative year, 4 strongly positive years. Cumulative total return in GBP, approximately 88% from a single ETF, 0.22% annual fee, completely on autopilot inside your ISA. That is what owning a slice of the entire global economy looks like over time. One thing I want to be transparent about. Approximately 65% of VWRP is currently invested in US companies. This is why we pair it with gold, because gold and US equities have historically moved quite differently. ETF number 2, and this is the one that surprises people most. Gold. I know what some of you are thinking right now. Gold? Really? Isn't that for doomsday preppers? I thought the same thing once. Then I looked at the data. Over the last 5 years, gold has returned over 110%. more than global equities, more than anything in a conventional portfolio. And in 2022, when equities fell nearly 18%, gold was almost completely flat. This is not paper gold. This is not a financial derivative. The iShares Physical Gold ETC is backed by real physical gold bars, actual gold, held in secure vaults in London under LBMA standards. When you buy SGLN, you own a fraction of actual physical gold. You just don't have the hassle of storing it yourself. Listed on the London Stock Exchange, priced in pounds, annual fee just 0.12%. Let me show you what gold actually did for UK investors over the last 5 years. And I want to walk through this year by year, because the story is more interesting than most people realise. 2021, gold was down 3.15% in pound terms. Sterling was relatively strong that year, and gold didn't have much to do. A quiet year, 2022. Now here is where it gets fascinating. In dollar terms, gold barely moved. But sterling crashed. Remember the mini budget? The pound fell sharply, and UK investors in SGLN gained 12.49% that year, while equities fell 18% and bonds fell 24%. Gold was up nearly 13%. A currency hedge and a crisis hedge at the same time. 2023, up 7.05%. Steady and reliable. 2024, up 28.4%. Gold starts its big run as central banks around the world start buying at record levels. 2025, this is the number that stops people in their tracks. Up 50, we are near 56% in a single calendar year, in pounds. 1 year, 53.56%. And 2026, we're only partway through the year, and gold is already up over 6%. 5 years, cumulative total return in GBP, approximately 130%. From a single ETC, 0.12% annual fee, sitting quietly in your ISA doing exactly what it was designed to do. I went back through every major market panic of the last 30 years. .com crash, equities 47%, gold plus 12%. GFC 2008, equities 55%, gold plus 6%. COVID 2020, equities 33%, gold plus 25%. Rate shock 2022, equities 18%, gold 1%. 6 out of 7 major crises in 30 years. Gold either held its ground or went up while equities fell. The one exception, the 1997 Asian crisis, both fell together, driven by a surging US dollar. I want to be honest about that. Now I promised you the full picture. Gold's worst ever drawdown was 1980 to 1982, a fall of 65%. But context, gold had risen 2,300% in the decade before. The most relevant modern bear was 2011 to 2015, a fall of 45% over 4 years. Gold falls when real interest rates rise sharply, when the US dollar surges, or when inflation fears subside. Knowing this, you can understand your portfolio at a deeper level. When gold falls, you're not panicking. You're buying at a discount. During the 2011 to 2015 gold bear market, someone investing £150 a month throughout that entire 4-year fall would have been buying gold at cheaper and cheaper prices every single month. Pound cost averaging protects you even in gold's worst bear. So why 30% gold? Because at 30% gold has enough weight to genuinely cushion a crash. In 2008, a 70-30 equity gold portfolio fell approximately 36% rather than 55%. That 19% difference is often the margin between staying in and panic selling. Your £500 a month, split 2 ways. £350 into VWRP, 70%, the growth engine. £150 into SGLN, 30%, the crisis shield. Blended annual fee, 0.18%. 2 ETFs, 1 ISA, 1 monthly habit. Right. Let's talk about what this actually looks like over time. We're going to use a blended annual return assumption of 8% per year, deliberately conservative. Actual 5-year blended annual return has been significantly higher. This is not a promise. You may get higher or lower than this. After 10 years of investing £500 a month, you will have put in £60,000 of your own money. At 8% per year, your portfolio would be worth approximately £91,000. That is over £31,000 the market has added on top of your own contributions. After 20 years, you have put in £120,000 of your own money. Your portfolio is now worth approximately £294,000. Let that sink in. You put in £120,000. The market gave you another £174,000 on top, nearly 2.5 times your contributions. But 30 years, your portfolio is now worth approximately £745,000. £745,000 from £500 a month. You contributed £180,000. The market gave you another £565,000 on top of that. You didn't pick a single stock. You didn't time a single market move. You just showed up every month with £500, and you didn't stop. That is what financial freedom actually looks like. I want you to look at this chart and find yourself in it. In year 1, the gap between what you put in and what your portfolio is worth is almost nothing, barely visible. You might wonder if any of this is actually working. By year 10, you start to notice something. The gap is growing faster than your contributions are. The market is beginning to do more work than you are. By year 20, the market is contributing more than you every single year. And by year 30, look at that gap. You put in £180,000. The market gave you back £565,000 on top of that, at 8%, at 10% and nearly £1 million on top. This chart is not about maths, it is about what happens when you refuse to stop. There will be a 2022 in your future somewhere, a year where your portfolio drops and everything feels wrong. That is completely normal. That is part of the process. The people who built genuine wealth are the ones who didn't stop. Where do you actually open your stocks and shares ISA? There are several excellent UK platforms. I'm going to give you the main names. Visit their websites directly and decide which suits your situation best. All of them are regulated by the Financial Conduct Authority. All offer a stocks and shares ISA. All allow you to set up a regular monthly investment so your 500 the habit runs completely automatically. Don't spend weeks agonizing over which platform to choose. Pick one that feels right, open the account, set up the monthly direct debit, and start. And if you'd like a detailed platform comparison, drop a comment below. Everything we've covered today comes down to 5 things. 1. Get the wrapper right. 2. Build the habit. 3. Buy VWRP. 4. Buy SGLN. 5. Don't stop. Ever. I want to say something directly to anyone watching this who has been meaning to start investing, but hasn't quite got there yet. The best time to start was yesterday. The second best time is today. If you start today, putting $500 a month into this portfolio, in 30 years' time, you could be sitting on something close to £750,000, tax-free, built from a habit that costs less than most people spend on subscriptions. Your action plan, 3 steps. Step 1, open a stocks and shares ISA. Step 2, set up a $500 monthly direct debit. Step 3, split my $350 into VWRP, $150 into SGLN. You can do all 3 today. If you found this useful, hit the like button, subscribe to Simply FinCon, and drop your questions in the comments. I read every single one, and finally one thing in now. One last reminder. Everything in this video has been for educational and informational purposes only. Nothing here constitutes personal financial advice. Capital is at risk. Please speak to a qualified financial advisor if unsure.